We're used to, having bank dictate the terms, and that's it. It's their money. What are you going to do about it? Now that they're kind of asking for more things, and the loan gets more complicated, you might have a loan agreement in addition to the mortgage. It's like another 30-page document. There's some room for negotiation, and the less the LTV or negotiating power you're going to have. Also, the lower the interest rate you're going to get.
Welcome, everyone, to the Casandra Properties podcast. We're joined today by a dear friend and someone who's worked with me as an attorney over the last, it's been a long time, right, Dan?
Yeah, years.
Years and
10,
years.
15, 20,
at least.
I don't know.
Yeah. Time flies when you're having fun, baby.
It does.
Dan Marotta, he's a partner at Gabor and Marotta, a company that was founded in 2006. They're a full-service law firm with a specialty in real estate and estate planning. As I had mentioned earlier, me and Dan go back a ways. We've developed a friendship above anything else, but he has been one of my absolute trusted allies in the legal profession, and a guy who really goes above and beyond in everything that he touches. So, Dan, thank you for taking the time to join us today.
Happy to be here.
Always good to see you.
It's good to see you, too.
Yeah.
I miss our lunches.
I know. Me, too.
Yeah.
We used to go and do the Chinese food.
Yeah.
We'd make the circuit around, right? But we're getting back soon.
Yeah, we'll get back.
Yeah? Are you going out? Are you?
Yeah. We'll go out to dinner, and, we're starting to get together with friends and family again, reconnecting with people.
Amy good?
She's great. She misses traveling. She used to travel a lot for her job, but, so she'll be getting back to that soon enough.
Good. All right. Well, I want to jump in. There's a lot to cover here today. Dan is going to lay down some serious value, folks, as we get into some of the commercial deals and what he's seeing in the marketplace and where his skilled hand is guiding clients through an ever-changing capital market, as the impacts of coronavirus continue to wreak a bit of havoc on the commercial market. But as we always seem to do, Dan, the audience likes to get a flavor of who you are and where you came from. So you speak fluent Italian.
I do. Sì, parlo italiano.
See that? Yeah. So you grew up in an Italian family.
I did. I studied Italian in college. I have family there. I have 2 uncles and an aunt who are still alive. My father's hometown, Sicily. And I have cousins in Milan and the South. I'd love to get back there soon also, and hoping to do that. Maybe not this summer, but soon enough.
So you were born here, though, right?
I was. The year my parents came here, I was born here.
And I assume you picked up Italian. You said you studied it, but clearly you picked it up at home.
That was my first language.
It was your first language.
Right. And then Sesame Street was how I learned English.
So growing up in an Italian household he's laughing already, right?
Yeah.
It has certain things that we're all familiar with in the Italian family.
Yeah.
At what point did law enter into your purview? I mean, is this something that interested you when you were young, or?
I guess it was probably when I was in college. I don't think I thought about it before then. I wanted a liberal arts education, and I changed my major, 4 or 5 times, from English to history to philosophy to government, and then economics, which probably made the most sense. And any one of those is good for law school, but I like reading, I like writing, I like arguing, I like dealing with people. So I like working. You know that.
I certainly do. So you have a hobby, and I was shocked when I found out how good you actually are and what some of the names are you've played with. So you play the guitar.
I do.
And you played some gigs with some pretty famous people.
We did. We've played with Ziggy Marley, the Ramones, quite a few others. I'm kind of blanking right now, but it's like a whole nother life.
Yeah.
But also kind of interesting was when while I was in college, we actually had a very serious group that toured, and that was where we, did these kinds of performances. And we were very serious young men at the time. And, I would read our contracts, and we had a lot of them.
Really?
Oh, yeah, we were pretty good. Touring the country 3 or 4 times, Canada, and when I got to law school, I kind of was very excited about that. I started an entertainment litigation law firm, some years later after graduating law school. But I decided at some point that even for all the clients I had, they were all buying real estate.
Yeah.
And I really don't have the kind of the time it really takes to be a full-time entertainment attorney. But I did it for a long time.
Real estate seems to be the mothership, right? In everything. For us, obviously, it's the mothership. We have a lot of different interests in different places and different companies, but it always seems to funnel back or originate from real estate.
Yeah. I remember my first law firm. I had a partner who is still a very dear friend of mine, and we had all sorts of really interesting clients. But every one of them, bought a condominium apartment, bought a house in the Hamptons,
Yep.
bought, a building. So I have always done that work, and today I enjoy it a lot. I have a lot of interesting projects going on, and it's been really good for the past year. Life for me in the pandemic is, like I said, I like to work. So I've had a lot of work between the commercial loans that I've been doing for businesses and companies, clients that have borrowed money on their real estate, and on condominium developments that I've been working on these small townhouses in Park Slope, Brooklyn, and Harlem, and some other places in Brooklyn where I've become a huge success. Folks are buying them. It's amazing, the sales that we've had over the summer. So between those two things, it's kept me busy for the last 12 to 14 months have been really good for me.
So it's interesting because a lot of folks that have come and sat in that chair have said the opposite, that they haven't been, as busy and they had the time to reflect and think and all that good stuff. But you've stayed busy throughout this. Why do you think that is? Is it certain submarkets in Brooklyn that are just kicking butt at this point?
I don't know. I think it's just, chance and luck would have it that, have 1 or 2 clients that started condominium projects that have come to fruition now, and other clients who, suddenly are borrowing money and interest rates being so low, right, that it's kind of hard to pass up. So, as you know, I do mostly commercial real estate work, and these commercial loans are a lot of work. I mean, it's it's not just a 1 hour, 2 hour closing, and it might take months to close that loan. But it's usually a lot of money involved, $5 million and above.
So one of the things that we wanted to take a bit of a deeper dive in was the commercial loans. And, we've talked on this show quite a bit about, as we emerged here, we didn't know, and we still don't know, like, where are the courts going to land on a lot of these issues. With commercial, of course, everything starts with the leases and the revenue, right? If you can't paint a clear picture of what the cash flow is going to look like, it's difficult for anybody. And the banks certainly get picked on in this regard, but it's tough for them also to see a clear value. So they're taking extraordinary steps now, right? They're doing a lot of things that in the past they had not done. And I know that you've become quite an expert in this field. So I thought it would be great for the audience that is looking to refinance their commercial real estate or they're looking to make an acquisition, if we could talk through some of the things that you're seeing now that perhaps in the past you didn't traditionally see and things that you really should keep an eye out for, because many of these clauses that they have in these loan docs now are not customary unless it was like, straight CMBS money. A lot of these things you wouldn't find in traditional loan docs.
Yeah, I find that's exactly the case, which is, the requirements are a little bit, more reaching, maybe overreaching in some cases, and you have to push back. And, I have to say that we've been successful in pushing back with a lot of lenders because, it's in their best interest to ask for everything that they can think of.
Yep.
To secure their collateral. But, you have to look at it and ask if they're going too far. What's the reasonable thing to do? And is there some kind of, solution that, maybe isn't as painful? Because you really don't want to have, your rent roll tied up in some lender account or, be under the threat of a default, for, years on end. So I think the first thing we should probably touch upon is the driving force behind all of these loans is the interest rate.
Yep.
So the rates are low, and so sometimes it's amazing to me a client will come and that's really all they care about is what rate they're going to get. But on most of these commercial loans that we've had, several over the last year alone, again in the kind of over $2 million, over $5 million range, the interest rate won't be a guaranteed rate. It will be something like 200 basis points over the swap rate or the treasury rate or, something to that effect. So you have to look at what, those rates are in effect, and then the rate will get locked at the closing. So you have to keep your eye on the ball. Sometimes I get the sense that, the closing's getting delayed a few days to see which way the rates tick up or down. But, if let's say you looked at the rate and it was, the swap rate was 1.44 and you're 200 over that, so that would give you a rate of 3.44. That's great, okay? If you suddenly put the closing off for another month, that could go one way or the other. And on a big loan, every point matters.
So a lot to go back on there. You said something that I think is of particular value, and that is you are pushing back and you actually are getting traction with the banks. So that's point number one, folks, is as Dan had mentioned, we get so hyper-focused on the rate. And, that's all we kind of see in this process. To know that in a time when it's a challenge to secure commercial financing, that then what Dan is experiencing is that you actually can push back on some of these clauses. And we're going to get into a deep dive now on what these clauses are, what they mean, and what to look out for. But something else you touched on that I just wanted to double back on quickly was, the delays, the intermittent delays that you'll get because the rates are not fixed most times until the closing, and they are based off the treasury or a swap rate or something like that. And what seems maybe not to be such a big deal to the investor in the moment, if that rate is moving 5 basis points, 10 basis points, right? That's a big deal for the bank. That's a really big deal for the bank. So whatever your rate is tied to, you want to keep a close eye on that and make sure that the bank is not pushing you off when it's coming time to close, and that you're getting in there at the right number. Now, are these fixed rate loans, Dan? Are they fixed for 5 years, 10 years? I can't imagine they're fixed for the term of the loan, are they?
Yeah, they will be with some caveats. If you fall behind on debt service ratio, or if you don't meet some reserve requirement, there might be a tick up. But yes, so you can get them fixed, so that that is a great advantage to you. Some might be fixed for a certain time. So one negotiating point is, what what's the loan to value ratio?
Yep.
Right. I mean, so okay, everyone on this knows this, but I mean, when you're dealing with a $5 to $10 million loan, this is a big deal. Is it 50%? Is it 70%? I mean, if you're at 50% or less, you're going to have a lot of negotiating power, more than you think.
Interesting.
Right. I mean, for real estate attorneys, we're used to, having bank dictate the terms, and that's it. And it's their money. What are you going to do about it? But now that they're kind of asking for more things, and the loan gets more complicated, you might have a loan agreement in addition to the mortgage. It's like another 30-page document. There's some room for negotiation, and the less the LTV, the more negotiating power you're going to have. Also, the lower interest rate you're going to get, along with if the term of the loan is shorter, right? So you're going to get a better interest rate, of course, on a 10-year than you will a 15-year loan. So all those things come into play when you're bargaining for the interest rate. Unfortunately for me as the attorney, by the time I get an LOI or some agreed term sheet, they've agreed on the rate. But if I see that they're not even at 50% LTV, loan to value, I bring it up over and over and over again. We'll beat them over the head with it in trying to get what I want written into the mortgage or written out if I think it's overreaching.
So based on, first of all, for a point of clarity, Dan's not talking about repping the banks. Dan's repping the purchaser, the candidate that's refinancing, and if the LTV, loan to value, right, folks? So when you go to buy a property, the amount of money you put down gets measured against the total cost, and the balance is what's financed by the bank. So if it's a 20% down commercial deal, you're not going to have as much leverage as if you're a 50% down borrower, right? You have more strength, more leverage. And again, I've been doing this for 25 years, and I can count on one hand the amount of times that the attorneys have been able to really negotiate in those terms. So it's great to hear that that's happening. And I think what I'd like to do, Dan, let's go through some of these items that you're seeing occur in the loan that may be subject for negotiation, right? Why don't we run down a couple of them one at a time so that we can let folks know, hey, open your eyes beyond the interest rate, engage your counsel in some of these clauses that you may have some leverage in.
So, okay, one that you and I have talked about before are debt service ratio requirements. So this is where what is your net income divided by your monthly loan payment?
Yep.
Okay. So they want to see that you have a healthy amount of rent revenue coming in at all times during loan. Again, to make sure their collateral is safe, so a bank's going to want at least 1.3 or 1.5, ratio. So 1.5 would be if you had a monthly payment of $10,000 a month, you're collecting at least $15,000 in rent.
Yep.
So what happens if you don't? They're not going to approve the loan unless you do in the first instance.
Yep.
And then they'll have these provisions that really need, some careful reading and some careful scrutiny, which there'll be a whole section on a definition of what the debt service ratio is. There'll be the penalty for falling below it, which will be usually either a cash sweep or what they call a lockbox. So what that means is typically these banks will require that you open an account with them, an operating account, where you deposit all the rents. Now you're continuing your business as you would normally, collecting rents, depositing rents, making your mortgage payments, paying your taxes, insurance, etc. But once you've had, let's say, an unexpected reduction in rent collections, and the bank finds out about this, and you fall below the required ratio, these trigger events will include falling below that ratio for maybe 2 quarters or whatever the loan document says, and then your account will be inaccessible to you, meaning they will lock this account, and you will not be able to withdraw money from it or do anything with it other than pay the mortgage without getting prior approval, which is a process in and of itself.
So I just want to pause you here for a moment because I had this come up in a loan, and I was shocked at what the bank's position was. So thinking logically, it was a debt service coverage ratio of, I think, 1.35. And the fear was there was a tenant that was a junior anchor, right? They weren't the full anchor, but they were a junior anchor, so they occupied a good chunk of the GLA, right? The gross leasable area in the center. And being, involved in the business the way we are, we had heard some rumblings that perhaps there was trouble, on the horizon, and that the brand may not be solvent in the future. They may go into a bankruptcy and a repositioning. So when we were discussing with the bank, we said, well, hey, look, as long as we're staying current, right, and we, meaning the purchaser, as long as the purchaser is current and they're making their payments, surely you're not going to lockbox the account just because it falls below the debt service coverage ratio, right? If the landlord's willing to continue to pay and even subsidize those monies, you're not going to lockbox the account, right? And the answer was, oh no, we are definitively going to lockbox the account. So it doesn't matter if your note is still performing. It doesn't matter if you're still paying.
Yeah, so we haven't been able to get around exactly that. We have written in some other options that have worked. So I tried to, let's say, have a lockbox only if the loan is declared to be in default.
Yep.
Stop paying, or otherwise materially default. But they want more than that. It's not going to let you off the hook that easy. But what we were able to write in on several loans, Bank of America, another bank, Key Bank, was that there'll be a cure period. So the cure is pretty standard, actually. There would be something like, if you demonstrate for 2 consecutive quarters that you have now, increased the rental revenues. Or the other cure, which, we came up with, was that you'd be allowed to make a capital infusion that would help the cash flow.
Okay, so they allowed that for you.
Yeah. So it was, we had it on several loans. We've had it done in several loans, so it can be done.
Wow.
And of course, that requires you to have the ability to make those cash infusions. So let's say you're short $10,000 a month, you may need to infuse 6 months worth, $60,000, in order to avoid the lockbox trigger event.
Right.
But you really want to do that. So, once your bank is now holding all of your rent money, you're really in a tough spot. So there are some ways to get around it. Also, we were able to fight a couple of times on getting it reduced from 1.3 to 1.2, or and then we saw other provisions tied to different debt service ratio requirements, and we said no, there's going to be one formula to remember, and that's it. Again, I think that depends on your bargaining position, and again, how much are you borrowing? What's the LTV, and how favorable is the interest rate you're getting, and what's the terminal loan? But what is the formula is the first issue.
Yep.
And we've had long, hard conversations with clients. Let's look at your rent roll. Let's see. How long have these folks been here? Are they going anywhere? Is there any tenant that looks problematic to you? Amazing that all the loans that we did in the last 12 months, the tenants have been paying.
Wow.
So go figure.
Before we move to the next thing, I just want to ask one question related to the lockbox. One more question. So are you finding that they are requiring the replacement tenant? Are they putting any boundaries around the replacement tenant? Meaning that in one of our instances, we found not only were they going to lockbox the account and not allow for the cash infusion, if the replacement tenant was not of equal or greater credit, that the account would remain lockboxed.
I haven't seen that one. I would certainly push back on that. I'm not sure what that achieves for them. So I would have to understand why.
Well, I pressed on it, right? And I think their position was, look, we don't want you taking Joe Blow's widget factory and saying you signed a lease with Joe Blow's widget factory and you're replacing Gap.
Yeah.
Right? So they wanted, I understood the point, but that gets really sketchy, right? Equal or greater credit, at what time, what credit rating agency, if the company in our argument was, well, if they're headed into a default and a bankruptcy, their credit obviously wasn't very good at that point anyway. So we went back and forth, and that was a very tough solve for. It was a very difficult loan.
I don't recall that issue coming up. I do remember there being some discussion about it being a bona fide tenant, not just some partner you put in there that's paying phony rent. But I don't remember there being an issue about having a certain quality of credit for the replacement tenant. I didn't see that language, but I'll keep my eyes open for that. I certainly would be careful. I want to make this other point. Maybe we could talk about it a little bit. I've also had some experiences where clients took on partners.
Okay.
Instead of borrowing money outright, they had an institution or hedge fund or some other kind of banking type of company invest with them in their real estate. And on a couple occasions, quite disastrous because it's financial institutions and hedge funds, and they're good at managing money.
Yeah.
They're not good at managing real estate. Huh?
Yep.
So, when you have to make emergency repair, you have to make an emergency repair. There isn't time to, produce a spreadsheet and
go to a boardroom
and have a committee meeting over it and submit a requisition form. The boiler has to be replaced. It has to be replaced, right? So these types of partners don't understand that. It's just not the world they live in. So, while it might seem like a good idea, it may have been pitched, as a good idea. Something really to think about. As far as being partners with, somebody that's not, really a property manager. I bring that up because, in the end, they're probably also leveraging money somewhere else to put into your business.
Yep.
So, you're going to be subjected to all sorts of other requirements when you close on that investment. You'll also be closing on a loan, probably, that has a lot of these types of requirements, built into it.
Right.
So you want to make sure that if you have a partner, even if you're the managing member, they're going to retain all sorts of approval rights in your operating agreement. So you want rational, business partners who have real estate experience if they're going to have a say about real estate management.
Yeah, right? It's a great point. You need to make sure that if you are bringing in an institutional investor, that you're aligned with your document with them and your document with the bank, right? Especially in the event of some of these defaults. So are these loans that you're doing, are they full recourse or partial recourse or?
Yeah, so they say they're non-recourse, but they're really, non-recourse with bad boy carve-outs, they say, right?
Yeah.
Yeah, so, which tends to be a little bit more expansive than what you think, but basically that you haven't engaged in fraud or misrepresentation, but then they'll also probably keep you on the hook for environmental indemnification and the like. Some of those items are not going to be so easy to negotiate.
Yep.
But I'd like to tell you about a couple others that we had some success on, and that I thought was strange to begin with.
Yeah.
I see that, there's always now, some kind of escrow reserve requirement, and it's, all different varieties. There's repair reserves, the replacement reserves, maybe there are debt service reserves, or, some kind of rent reserve. I had that today, 6 months rent reserve to be deposited in that operating account with your bank, and it will stay there for a year, they wanted.
So they want you to, so let's start with rent reserve.
Okay.
So in this instance, they're asking you to deposit the equivalent of 6 months up front, or
Yes.
are they allowing you to build up to 6 months? So no, they want you to cut that check up front.
Right.
Wow.
Yeah.
Is it interest bearing by any chance?
No.
It's not.
No.
Okay.
So that's what.
Of course not.
Right. So on these reserve accounts, it's very interesting because these banks, I think, love these reserve accounts because it's money that they get to hold on to interest free. And once it's in there, it's really not so easy to get it out.
Yeah.
And we have been successful in trying to, write into the mortgage or loan agreement, more reasonable requirements of how to get money out of a repair reserve. But they're still going to want you to show that either you've already performed the work and you're seeking a reimbursement.
So this is on repair reserve.
Yeah, on repair reserve.
So they're not allowing you to take the money to do the repair. They want you to do the repair first.
And in many cases, that'll be right. Yeah, that'll be the case. So you'll have to actually be getting reimbursed. So now you're putting cash into it, and then or using whatever you have in your operating account, and then trying to get it out of the reserve account. I found on a couple of loans we had that the provisions regarding the reserves were even that they don't have to account to you for this money. They can commingle it with other funds from other loans involving other properties. So, for them it's money that they're tying up, and for you it's money that you think is there to make the repairs, but really again it's for the bank's protections.
So that's a super important point. You're saying that in some instances, they're taking these reserve accounts and they're writing into the docs that they can commingle it with other monies from other properties, and I'm sure they're using it against their ratios of what they're allowed to lend. In some instances, perhaps they're dropping it into, overnight treasury, right, and picking up interest on it.
What they do, whatever voodoo they do.
Yeah. So,
but I'm a very cynical guy. I just see these kinds of provisions. I just scratch my head. I know you're not going to negotiate that out of it.
Yeah.
Because clearly that's something that they're going to require. But I'll tell you another. One instance we had earlier in the summer was the bank was getting ready to close, and I had started asking right away. Okay, so you keep talking about this property condition report. When can I see this property condition report that we paid for? Right, the commitment fee was like $35,000. Okay, so that was to cover environmentals, property inspections, their legal fees.
And it's their inspectors. It's their inspection.
Yeah, they choose.
Right. You don't get to use your own, by the way.
Right, but and it won't give you a copy unless you really, really, push them for it, right? And I did right from the beginning, and then of course, now we're like scheduling and closing. I still want this property condition report. Why? Because they're basing this repair reserve on a property condition report, so they want you to hold $150,000.
Right.
Why? Why am I holding $150,000? Oh, to cure the violations. Well, okay. So I get a copy of the report on this particular instance, and I look at it and I say, no, there aren't 10 violations on this property. It's incorrect. There were some HPD violations, and there was an elevator violation that was being addressed, but it's maybe a couple other items, but the violations that they said were there were not. So right. Now that they spring that on me, just, in the last leg of, this long journey that we've been on trying to close this loan. And I don't think they were withholding the report or anything like that. I'm not that cynical. But, clearly without me seeing it, I couldn't point out to them it was wrong, right? Because, in their mind, oh, great, we're going to have this repair reserve in case something happens. So good for them, but bad for borrower.
Right.
Why is this money being set aside for no reason? How am I ever going to get it out? So those are the clauses to look for, though. How to get it out. Do I have to make a written request? Is it only for reimbursement? Are there scenarios where I could get the money without being, without having to make the outlay? What is the, I've tried successfully and sometimes not to put a time limit on. If you make a request with attaching appropriate invoices, that they'll release the money within 30 days.
What if they don't? Right? What if they don't perform? Do you have any recourse? Is that,
Yeah, not really. You're not going to get into some litigation with your bank over a repair reserve. I think your best bet is to clear up whatever you can clear up before you close a loan, obviously.
Okay, good advice.
Right? And then when they hit you with this repair reserve, try to whittle it down to the lowest amount of money possible. That's what we do. So, instead of holding $150,000, maybe only $50,000 or $75,000, or, something that, is more palatable, in the long run. So, on these kinds of loans where you're paying this type of origination fee or application fee, they sound like big numbers, but they're not.
Yeah.
At the end of the day, you may be pulling some money out of the loan, right?
Yep.
Not in addition to getting a really low rate.
Yep.
You might, getting some money, putting some money in a repair reserve is, just par for the course. It's, what you just have to do.
So, can you speak to what a cash sweep is?
Yeah. So the cash sweep would be when you have fallen below the debt service ratio, and they have now declared that all rents that you're collecting need to be deposited in that account, and you cannot access the account.
So that ties into the lockbox.
That's the lockbox.
That is the lockbox. Okay, so the cash sweep and the lockbox go hand in hand, and the replacement reserve goes hand in hand with the repair reserve.
Well, replacement reserve is for things that you anticipate replacing, capital improvements.
So they want
Roof, elevator.
That's not a repair. That's a different reserve.
Yeah, exactly. Right. So you have to be on guard for all these things, right? You have to, look at. Some of it will be spelled out in the initial. Sometimes they don't even call it a commitment letter, right? It'll be an LOI. Or it'll be some term sheet or an application. $17 million loan we closed. They called it an application. And every time I asked a question, they said, "Well, it was on the application form you signed." It's kind of hard to argue with that. Well, once they've agreed to give you a certain interest rate, once they've agreed to all these other terms, to go back and renegotiate something that your client signed and agreed to in writing, it's not going to happen.
Right.
So, with some exceptions, right? I had one where they had 2 or 3 buildings in Queens, Brooklyn, same client, same bank. So, I don't think they understood exactly the ramifications of the cash sweep and the lockbox. I think the ratios were just too high. Not that they would ever have the problem. It seemed like they had a very healthy rent roll. But you have to live with it for the life of the loan.
Yep.
Plus, they're going to sell this loan, so you don't know who you'll be dealing with down the road.
Yep.
So you want to make sure that you get the best possible terms in the black and white that you can. So replacement reserves are just a different kind of for capital improvements.
Okay, so something you touched on earlier, I wanted to go back for the audience and just expand on a little bit and offer some clarity. I had a client recently who someone we know, someone who's got a lot of experience with commercial real estate, and they didn't even know that non-recourse loans existed. So I just wanted to spend a minute here. Folks, when we say non-recourse, there's different levels, right? There's full recourse, limited recourse, non-recourse, and everything in between. So for a non-recourse loan, that means that if the loan goes bad, they won't come after you personally. So in theory, right, technically, as long as you're in compliance with your loan documents, if things take a turn south, let's say you have a center that you bought, 15 years ago for $10 million, and your loan is down to $3 million and it's worth $20 million now, right? And you want to go for a 75% LTV, you go get a refinance for $15 million. So you have all of your initial investment out, plus you've got $5 million of the bank's money. You can actually do that in a non-recourse loan. Now, there are other things that you pay for that benefit, but the thought process is if things go bad, you leave the keys on the counter, the bank picks it up, they take the asset back, and you are not on the hook personally. Then there's full recourse, which of course means that you're on the hook personally, and if things go south, they can, and in many instances will come after you personally. And then there's limited recourse in between. And another term Dan threw out was a bad boy carve-out, where you'll get a non-recourse loan so long as there's no fraud or there's no intentional bad boy activities. Otherwise, you can actually get up and kind of push away from the table at one point if the deal goes south on you. So, recourse, cash sweeps, repair reserves, replacement reserves, debt service reserves, that's why you get the right attorney, right? These are the reasons why not all attorneys are created equal, and not only should they be educating you on these clauses, as Dan is pointing out, he's having success in actually battling back some of these things. So let's keep that, top of mind, folks, as we emerge from this thing and we're out there transacting in the commercial world. These are really important items. I know, Dan, you had referenced that entity structure is something that they're looking at now. Could you speak on that?
That's pretty standard also. So they will have these SPE requirements, single purpose entity. So they want your corporation or limited liability company to agree that its only business will be managing this single real estate asset. It won't acquire other real estate assets. It won't engage in any other business. It won't make loans to anyone. It won't borrow money. It won't do anything except for collect rent, maintain and manage property, and pay its mortgage. Most often, your operating agreement probably doesn't have such a thing. Why would it? Probably has more generic purpose clause, or even for real estate entities I create, usually leaves some room for maneuverability.
Yep.
They are going to want, if you're a limited liability company, an amendment of your operating agreement, or if it's a corp, an amendment of your shareholder agreement. And one thing that I found was that if you have a managing member and he has authority to make those kinds of changes, then that's easy. But if you have multiple partners in an LLC, let's say, and you require unanimous consent to amend an operating agreement, now you're going to have to go to each one of them. And it's going to be the 10% guy that gives you the hardest time about, agreeing to sign a resolution or an amendment of an operating agreement so that you could get the loan. We had a couple instances over the last couple of years where, there's a holdout, and, now they're suddenly making new demands, and they, want to place restrictions on what the managing member can do, and other provisions in the operating agreement that maybe had existed for years. Now they want tweak them, and et cetera.
So you're talking about when a potential minority investor in the deal, right? Let's say there are, 3 partners, 2 of them have 45% and one has 10%, right? So you're going for a loan, this comes up. Now you need a sign off from the 10% partner who otherwise didn't have much say in the deal. They're a passive investor and you can't get the loan without their signature. So now they're going back to the partnership and seeking leverage in other items. And you've actually had this happen.
Oh, yeah. And most recently it was very painful because it was the minority investor was a trust. And then now I'm dealing with a trustee and the trustee's attorney. Oh, explain to me the interest rate. Explain to me this lockbox.
Right.
So as you can imagine, here we are saying, well, the loan is going to close,
right?
In a week. 10 days, 2 weeks, whatever. I mean, how long is it going to take to explain a highly sophisticated, complicated, mortgage? It's not, they're not your standard mortgages when you're talking about, this type of lending. So it's not so easy to explain to someone. And then, they're now, going to really delay you. And, probably try to second guess the managing, partner of, well, I got a bank that will give us a better rate, right?
Of course.
Of course. I met this guy on the golf course,
right?
And, he's got a better deal for us, so you have to do that dance. And I mean, I don't know how to get around it other than, when you set up an entity or, so we had one where the managing member, certainly had, authority to enter into loans, take mortgages out on property. And exercise in discretion in doing so. But the operating agreement had required unanimous consent to amend it. So, that's, where you run into the issue. Because the bank's going to require this SPE.
So where is the solve here? Is it, so just so I'm clear on this, is it that the bank, so let's say we have an entity where there's 3 partners, 45, 45, 10, right? And one of the 45 is the clear managing member and they have full authority to secure loans. Will the bank generally accept that? Or if it's not clearly prescribed in the operating agreement, then you need all 3 partners?
If it's not clearly prescribed in the operating agreement.
So that's where you cure it.
Yeah. I mean, the bank the bank will probably ask for everyone to sign off on it anyway. So in some instances, we've said that's not going to happen.
Okay.
Yeah. So, the agreement clearly, the operating agreement we have clearly says it's just a single asset. Maybe because we've already financed, right? So we already have it written in. You can push back on in that instance and say, look, the loan's not going to close. If I have to go to every 5%, guy in the LLC who maybe has not been too happy with management, maybe has been, who knows. But, for me, it's a nightmare because inevitably they say, all right, show everything to my lawyer.
Right.
Now you're talking about another, 2, 3, 4, 5, 6 weeks delay, which, again, maybe sitting there watching a LIBOR rate or swap rate go up.
Yeah, sure.
While you're sitting around waiting for someone new to the game, to come up to speed. So, what can you do? I guess you could probably the best bet would be to make sure that your managing member has the right to amend the operating agreement. I mean, that's not going to go over so well with a lot of attorneys who might represent the other members, non-managing members. But maybe you could be more specific about that. For limiting it to financing or limiting it to special purpose entities, or creating entities that are special purpose entities for exactly this purpose.
Right.
So that would be one way to deal with it ahead of time. But usually it's by the time it comes to me, it is what it is.
It is what it is.
And I have to unravel it.
Yeah.
And, fight my way through it, whatever which way I have to.
So, if you're thinking about financing, folks, if you're thinking about an acquisition or a refinance or whatever it may be, and you have the entity set up, it would be wise for you to take a look at your docs before you get to that point, just to avoid, if you do have minority partners, getting into a pinch point there where someone has leverage, and like Dan said, you're watching the rates climb, and you're going through a very difficult document with a minority partner that's leveraging you for rights that they never were intended to have, and they never should have had, just because they have a signature because you didn't set your entity up right. Okay.
So here's another one that came up recently. Sometimes if you have a multi-unit building, you'll have a property manager that you've hired. Might be a company that you use on several of your real estate properties. Might be someone that you've had for years. The bank is going to want to know who they are, review a copy of the property management agreement, and in some instances have the right to replace them. Mm-hmm. So that's been a big battle on a couple of these loans we had last year. Where I think we ended up that they would only be able to exercise that right if the loan was in default beyond the expiration of any cure period, right? Because you really don't want the bank telling you who your property manager is.
I've had that on the real estate side, right? As the leasing agent, I've had instances where we've gone through and we've done our pitch and we've sold the partnership. In some instances, we've represented the partnership on many different assets. And when it came to financing, we basically had to re-interview for our jobs with the bank to prove to them that we were capable of undertaking the assignment, and we were going to dedicate certain resources. And it's gone so far as they wanted key persons from my organization that were going to handle the assignment. So,
And this might be useful to you specifically. We had a management agreement that covered more than one building, and that turned out to be a huge problem, especially when the client, who owned multiple buildings, decided to go to a different bank for one loan on one building as opposed to the loan they were working on with another bank on another building. So my recommendation there would be, if you have a property management agreement in writing, have it limited to the real estate property at issue, right? And then if you have, if you're a good property manager, you're not just managing one building for a client, you're probably managing 10.
Yep.
Okay, so have 10 management agreements.
Got it.
I'm not saying it's just the lawyers make money, but I'm just giving you the reality of what it means.
So, folks, these are things that I've sat at the closing table I don't know how many times over the years, and many, many times these are items that are just not addressed. So again, especially today where it's competitive out there with financing, these are things that you really have to keep an eye on. Believe it or not, Dan, we're already coming up on an hour, but before we wrap up, I wanted to ask you just your general sense of what do you think is going to happen here as the courts reopen? I know it's a crazy broad question, right? But do you think that the courts are going to start, ruling on each individual instance with who's paying rent, who's not, what are the rights, what back rent? How are these? Is there going to be a precedent set, and then everyone's going to kind of follow suit? How do you sort this mess out now?
I have to say, first of all, I don't do any rental collection work.
Yep.
So I, tried to stay away from that. And I really don't know the answer to your question.
Yeah.
We have this moratorium that, I'm not exactly sure what it means or says.
Nobody's sure.
How to navigate it.
Yeah.
I don't know what they're going to do. What I am hoping is that, regular court business, will start to come together. I don't see it happening really before September. Mm-hmm. They're going to start doing trials, but everything's an experiment right now. It's still not, the courthouses aren't open doors to the public, not even lawyers. So some courts. I mean, as I mentioned, we do a lot of estate work, and sometimes we handle some big real estate that passes in estates. And I'm happy to say we had a virtual court hearing this morning that went okay. It went well. And I know that folks have been doing trials with Zoom, and of course you've seen the famous "I'm not a cat" video clip. So the technology is sometimes a little tricky, let's say, but folks are getting the hang of it. Courts are getting the hang of it. It's kept me out of the courthouse and in the office making money, which is good. Getting work done is good, but certainly it'd be great to go back to face a little bit.
Right.
You really need that, and and somehow in video you're shouting, you can't hear you, the microphone's not working.
Yeah.
But we're hoping all that will come together by the end of the summer. They're ordered everyone back to the courthouse May 24th.
Oh, okay. May 24th.
So at least in New York State. So, meaning the court staff, clerks, judges, court officers, and the like. So I don't think you're still going to see lawyers going into the courthouse or the general public, except for some limited jury trials that they're going to try. I don't know how it's all going to shake out yet. It's been a very challenging time, and some folks have risen to the occasion, and I think the technology's moved a notch.
Sure.
So those are good things.
Yeah. Progress.
Some folks I feel like I'm better at some things now. More on top of some things that I've been forced to focus on.
Yeah.
Managing people and managing calendars and events. So that's all good. So,
how do people get a hold of you? What's the best way?
Probably the best way is the website, www.gabormarottalaw.com, GABORMAROTTALAW.com, or 212-349-1200 is our phone number. But the website has my email address. I always return emails. We do real estate purchases for people who are buying condominiums, people who are buying apartments. We did a ton of sales this summer from the condominium conversions I did in the last couple of years. Brooklyn is hot.
Yeah.
Folks are leaving Manhattan high-rises and buying these luxury condominiums in Brooklyn. And it's really been astounding to us, the demand for it. And folks paying $1-2 million for a walk-up apartment with, 2 closets, but in great neighborhoods, beautiful streets and that kind of thing, and even other parts, of the city. So those are good things. That's kept me very busy this summer, and I'm happy to help anyone with that kind of investment in mind.
Great. Well, folks, when you're over on that website, check out Dan's blog. He's got a great blog, wide variety of topics. So, as always, it's a pleasure to see you, my friend.
Good seeing you too, pal.
Yes, sir. Everyone out there, please stay safe.